Hi, this is Lex, and welcome to the FinTech Blueprint. It's your podcast about fintech, decentralized finance, digital banking, investing, robo-advice, artificial intelligence, and all the other frontier technology that is transforming financial services. To get more content, like an illustrated transcript of this conversation in your inbox, subscribe at fintechblueprint.com. So without further delay, let's jump into today's episode. Welcome, everybody. I'm so excited for today's conversation with Karn Saroya, who's the CEO at Cover. And we're going to talk about entrepreneurship as well as insurtech and what it means to grow an insurtech company and all the things around it. With that, let me welcome Karn to the podcast.
Thanks for having me. Appreciate it, Lex.
My pleasure. We often start the conversation trying to understand how folks got to, what was their journey or what was the adventure that they went on to get to where they are and to find the types of insights that led them to their current company. Can you talk a little bit about, the early entrepreneurial part of your career and what were you focused on? What were you trying to do?
Yeah. So look, I graduated I did a grad degree out of MIT and I ended up as a management consultant working with financial services companies. And pretty much day one, I knew that a properly risk-adjusted return path wasn't for me. I was spending my evenings and weekends learning how to code, dreaming up experiments that, myself and my high school friends could run and potentially scale into businesses. Ultimately left being a management consultant to sleep on my friends' couches in San Francisco as I tried a couple of different things and raised money for a couple of different things, but settled on, as our first experiment, StyleKick, which was an e-commerce marketplace that, sold high-end fashion on a small screen, one of the original e-commerce marketplaces on iOS and on Android. The basic premise behind that was the service served up a number of outfits. Your interactions with those outfits as you kind of scroll through them would inform what we showed you next. And that business itself grew to about 1 million active users. Incredibly interesting experience, seeing tens of thousands of people join that service every single day. And then ultimately was absorbed into Shopify, where myself and my team ran an early product team out of the Toronto office.
How or why did you come across this sort of trend? How did you discover it? What made it apparent to you? This is a behavior that people did.
Yeah, this was early Instagram, right? We were looking at the types of content, the types of behaviors in the communities that were being formed on Instagram. And in and around that time, there was kind of a derivative of Lookbook and Like It to Know It. Other services kind of in a roundabout way made shopping possible on Instagram. And so we endeavored to build out something that made it a little bit more seamless and a little bit more interactive for that community. Folks were able to tag looks, able to sell their looks. And underpinned by all of that was, there's some interesting technology that picked up on colors, styles, price points, brands that customers were interacting with and ultimately did a pretty good job of getting the right content to the right customers and the right users on the platform. So, it was a interesting journey. We actually, harking back even prior to that, we were resolved to do something in e-commerce, and myself and Anand, who's our CTO at Cover, went as far as building things like body scanners out of Kinect sensors with the Xbox. If you've ever played Dance Dance Revolution, it's a depth sensor and a webcam where if you've got an array of them, you can get a 3D body form. And we thought, hey, that could help inform purchasing decisions for folks offline once they've been scanned on, online once they've been scanned offline. So there was quite a bit of experimentation going on in that realm around then.
I'm playing Dance Dance Revolution right now. I do remember that was a pretty cool time where I don't know if Microsoft was even aware that, or I don't know if they designed Kinect for just how everybody was hacking it and trying to build these sort of early augmented reality types of experiences.
Yeah. So, at the MIT Media Lab, you'd see, folks, grafting these sensors to to drones and mapping out, buildings. And it was a fun and interesting time, that's for sure.
Can you talk a little bit about the experience of generating growth? Like, I think one of the things that fintech founders don't have an intuition for is like what people want. I think they come with this idea that like trading is important, so I need to build a broker, or health insurance is important, or whatever, a mortgage product is important, so I'll build a mortgage business. But they don't necessarily have this intuition around how to generate demand and how to create experiences to capture that demand and build around it. Can you talk a little bit about, in your early entrepreneurial journey, like how did you get to a place where you could understand what your customer, what that like the core loop was, and then building the sort of commercial experience around it? What was that like?
There are similarities and differences between what we did in the e-commerce realm and what we've kind of done within the fintech realm. And that's all to say that there's always a portfolio approach to growth. The stronger the product is at being able to drive a K value of greater than one, the less pressure you're going to ultimately experience on, in resolving the underlying economics of the business that you're trying to build. And so, I'll hark back to Stylekick. There are a ton of sharing loops into that product. Folks are actively engaged. There's user-generated content on that platform. Folks are actively trying to sell product on that platform. And so a fair amount of that growth came from user-driven processes within Stylekick. And the underlying incentive for a lot of folks, especially the most active ones, was to make some money. And you ultimately saw, that resolve into Poshmark and a handful of other guys that just did a little bit better or a little bit faster. Within insurtech and fintech broadly, if you take a look at the winners, there's certainly a huge aspect of product, ease of use, entering at the right time to share the product after, someone's had a happy moment, whether they've made their first trade or, earned an incentive for locking up some capital. So certainly a huge part of the product experience within fintech consumer has arced that way, ease of use, and then very, very clearly some sort of transfer of wealth, at least to subsidize for the initial risk of trying a new platform or service, which is why you've seen folks have significant success. With and to draw the direct analogy on some of the DeFi lending protocols where there is an opportunity to earn outsized returns, even in the form of synthetic ownership or participation of those protocols. Within the centralized realm, like certainly, folks focus on price, they focus on efficiency, they focus on cost savings, ease of use. And then everything else that rounds out a growth portfolio involves a lot of the typical tactics that folks employ. If you're a growth marketer, optimizing around SEO, hiring performance and paid marketing managers, building community around what it is a platform's trying to accomplish. So I could go on for a while, but that's the basic framework.
Yeah, it's interesting. You mentioned the platform playbook and user-generated content and the incentives that users have in using a product. We'll probably revisit that idea as we talk about protocols. But before we go into protocols, you sold the business to Shopify. You were at Shopify for a bit, but I guess the bug bit you again. How did you transition to Cover? And what is Cover?
With respect to Shopify, we had a pretty good relationship with the product team there. And we melted very, very quickly to work on, consumer-facing products. So we worked on a marketplace, we worked on, Facebook Messenger chatbot for commerce and a whole bunch of things. And ultimately decided we still had the itch. And so we applied to Y Combinator with Cover about 6 years ago. We knew that we wanted to do something consumer-facing because that was our forte. We built elegant, apps that have been featured by Apple and Google in every country, translated to practically every language. Had driven millions of people through our products in the past. And so, we were like, well, we should probably play into our strengths. And this time around, we wanted to do something that more quickly resolved into a business that was a going concern. One of the challenges we found with Stylekick was, building a business off of affiliate income, the LTV to CAC dynamics just didn't make sense, at least in the configuration that business was formed. With Cover, Cover's an insurance company today, but started as a lead gen business. And so we built a very simple app that took in pictures and videos of property that people wanted to insure. We weren't an agency. we would take in the information necessary to underwrite that business and work with insurance companies and insurance agencies across the United States to fulfill those requests. A couple of things happened that pushed us in the direction of becoming an underwriting business. We found that it didn't really matter how elegant the front end was. Simply, the front end was, folks ultimately cared about two things that weren't being fulfilled by our partners. And one was speed to fulfillment. Getting bounced around by within insurance companies or insurance agencies wasn't an ideal experience. And that wasn't manifesting in 5-star reviews for cover, at least initially. The second was that price, and especially with respect to policies that people have to buy. And we saw that quickly the types of policies folks were buying were converging on the things that were required of them to buy. So auto insurance policies, home insurance policies, renters policies. If they had pets, clearly like pet insurance, and maybe if they had jewelry, jewelry insurance, and that's kind of the pecking order. The other thing was very clearly price elasticity is very high within insurance, and I think within broader fintech. And there are a ton of intermediaries in this business and a ton of frictions in this business that keep the price, while relatively efficient, elevated. And at the same time, what we were finding was that there were significant opportunities for us to consume new information to both identify risks that were good, for us to take in the relative, in a portfolio, scheme of things, and fundamentally mispriced. And so we arced very quickly in the direction of, hey, we're now an insurance entity. We'll consider everything that a traditional insurance company considers, but we'll augment that with our own approach. We'll have folks take pictures and videos of property they want to insure. We'll have them enable basic UBI, location services. Perhaps they're a customer that's new to the country and don't have a credit score or haven't had time to establish a credit score. We can have a customer authenticated via Plaid and get financial transaction history in lieu of that, and a slew of other things that ultimately kind of sharpened our edge around identifying folks who are mispriced and ultimately offering them rates that were more competitive than the broader market. And so we hit on everything that we think folks wanted, which was speed, easy access and service. Every single one of our customers gets a dedicated phone line to be able to text at any point in time. Then, very, very importantly, price and price stability, mattered quite a bit to our customers.
I think it's a really interesting story of how insurance is becoming digital in the way that many of the other asset classes or parts of the financial stack have become digital. But there are many challenges and kind of reasons as to why insurance wasn't going first, right? There's a lot of Robinhoods out there and various brokerages and so on, but the number of kind of unicorn public insurtech companies you can count on one hand. And so there's some structural reasons, I think, for that. And I'd love to open up just the basic architecture of the industry for folks. So if you could put on the hat of trying to explain to somebody, what is insurance? What is a carrier? What is an underwriter? What is a broker? And just walk us through how this whole machine works.
Yeah, of course. So I guess what I can start off with is like, hey, at a high level, somebody needs to originate the business. Somebody needs to identify, a risk that needs to be transferred. And usually those are going to come in the form of agencies or brokers and, significantly a number of insurance companies that go out and they, run ads and attract you to buying their policies directly. And so if you're, let's assume that you're going through an agent is compensated on a commission basis, typically speaking, for originating risk. They're submitting you to a broader cross-section of insurance companies and or MGAs. And so the distinction between an insurance company and MGA, for the most part, is that MGAs don't take significant balance sheet risk. And so they'll do a broad variety of things, from originating, underwriting the risk. So this is ultimately deciding whether or not they're going to take the risk, establishing pricing, which is the methodology, typically speaking, that they are filing with insurance regulators to arrive at a price. Usually it's some sort of, multiplicative thing, starting with a base price and applying a number of factors to get to an ultimate rate. And then you're gated by an underwriting decision that takes in other information to decide whether or not to offer you the rate. is kind of the differentiation between underwriting and pricing. But MGAs, generally speaking, do all of that, servicing of the customer. So if you ever need to make a change, typically speaking, you're going to the MGA or the insurance company to your policy. And then beyond that, servicing of the claim. So, claims could be handled internally either by an insurance company or something called a third-party administrator. So when you pick up the phone, to make a claim, it's either going directly to the insurance company or one of their affiliates to kind of sort out that claim. And so MGAs, insurance companies are doing all of those things. Beyond that, what you've got is effectively, in some form or another, a capital markets function. And so a lot of MGAs, when they're not taking balance sheet risk, are kind of packaging up that risk and working with reinsurers to absolve themselves of having to make the claims or move themselves to a defined economics business. And so, cover as an MGA could earn, some ceding commission that helps it move to a defined economics business. And then all of the remaining premium is going to a larger, more diversified pool of capital in the form of a reinsurer, that is comfortable, taking on that risk, again, as part of a portfolio of risk that they manage in return for a premium. That reinsurance entity may also, by the way, find itself to be too concentrated in a given position. Maybe it feels like it's got too much exposure to wildfires in California or to hurricanes in Florida, and go on and repackage risk again. So, reinsurance, you consider insurance for insurance, but you also have a retro market, which is insurance for insurance for insurance. Ultimately, the risk is, there's this risk and capital matching mechanism that happens outside of the sphere of what traditional insurance companies and, insurance agencies do. And that could go as far as being packaged up into bonds, like insurance-linked securities that yield, as long as there isn't an underlying claim or catastrophic event that kind of wipes out the bond. So you have everything from origination, brokers and agencies, MGAs, through underwriting, pricing, servicing, which is insurance companies, MGAs. Insurance companies will typically take on most of the risk that is being brought to them, so it ends up on their balance sheet, but then the excess and or under certain situations is going to the reinsurance market, and then from reinsurance to retro. That's the basic construction.
Yeah, super easy, obviously. Derivatives on derivatives on derivatives, packaged as bonds is, I think, the punchline to every finance joke. I think there's also a lot of insurers have an asset management type function, right? Because they've got a whole bunch of premiums that they collect, and the payout of the premia is at a different time than the collection of the premia. And so they have to also sometimes run a gigantic endowment.
Yeah, so that's true. I mean, and the flavor of those things varies by the lines of business that insurance companies are in, right? So you can have, very short tail risks or risks that have significant runoff. So life insurance, workers' compensation, you can have claims that are being made, decades or a significant amount of time after a policy lapses. And so, when you're duration matching or you're thinking about, portfolio construction around flow, those are typical considerations around what you can invest in. And so the longer dated this stuff is, the less risky it needs to be.
That gives a little bit of a flavor of why the sector is difficult to innovate in. Which parts of it are you seeing the most competition or innovation in? And, do you find the most delicious in the sense that you think you've got an operating advantage and you think are kind of ripe for automation and change over the next few years?
Yeah. So I mean, I guess I could start off by talking about what I think hasn't worked particularly well, and talk about how things are transforming within insurtech and the direction that I think there's real value to be created. And so it's not a surprise that the public insurtechs have kind of been pummeled over the course of the broader market to a greater extent over the course of the last couple of quarters. A big reason for that is that it is like lending. It is very, very easy to scale an insurance business by underpricing. That is, and within the context of selling insurance on the internet, that is effectively giving away money on the internet. It's a very tough business to make work. So you've seen insurtechs put on hundreds of millions of dollars of premium in very, very short order. But you take a look under the hood, and there's significant adverse selection towards higher churn, higher loss ratio types of customers because of the mispricing. Or you have insurtechs that have taken very concentrated positions in catastrophe-prone areas where the outcomes are very binary, right? And that's a precarious situation because ultimately you're in a regulated space, and a regulator within insurance is primarily interested in making sure you're doing a couple of things. The first, you're being fair to your customers. You're not ripping their faces off with rates that are not commensurate with the risk. Second, and very importantly, that the rates that you're charging are adequate for the risks that you're taking on. Because if they're not adequate for the risks that you're taking on, you ultimately blow up. And so what you're now seeing is rates are rising, and rates are rising very aggressively, across almost all of insurance, but certainly personal lines insurance, to accommodate, for the at least initial, mispricing of the risks that were written. What does that mean for the economics of an insurtech or an insurance business? If rates rise very aggressively, typically speaking, you're going to see a lot of churn. And if you're seeing a lot of churn, many of the underlying assumptions that you made around, LTV to CAC or policy life expectancy, how long you expect an insurance customer to be around, kind of fall apart. And so you're stuck in a tough position where the revenue, the projected revenue that you had set out for yourself is significantly lower than you expected. The losses are higher. The market for eyeballs, that you've relied on very heavily, is still efficient, and the marginal CPA is still way too high. So you're kind of in a tough spot. So what I've painted there is a relatively bleak picture, right? But what I'll say is that it's actually forcing folks to refocus, outside of building technology to build efficiency and great user experiences. It's really forcing folks to think about insurance from first principles, right? And so what you're going to see out of what's happening here is, at least in the public markets and with some of the public insurtechs, is some of them, and some of the ones that are not public, are going to arc towards being really, really good underwriting businesses, incorporating unique data sets to become much more refined at risk selection and pricing in a way that they haven't really been focused on over the course of the last couple of years. That's almost certainly going to become true. The second thing that I think is going to become true is that if you're focusing on software experience and you're focusing on underwriting the actual insurance of the business of insurance, you become a little bit more agnostic with respect to where you're originating the business. And so a lot of folks went out and decided that they would be direct-to-consumer businesses, and almost stubbornly so. When that's a very, very, as I described, the value chain, it's a very large surface area of problems. There are many, many moving parts. And you're going to be best suited if you kind of narrow the scope of what you focus on. And so one of the things that we've done at Cover is, we've very, very quickly realized that, hey, like we're decent at underwriting, like our loss ratios tend to be better than the broader insurtech market. To pick up scale and kind of move ourselves in the direction of a variable cost business, we own Cover.com and we have our apps, but we certainly already were building software for our internal agents to make it dead simple for them to sell, not just Cover, but a broad variety of other insurance products. And so now what we do is we actually operate a direct business and we're a hybrid. So we have this instance of Cover that sits in front of something like 3,000 brick and mortar agencies in the United States today. That makes it dead simple for them to sell Cover, to plug into, as an independent agent, pull in unique data sets, directly from the customer that helps them arrive at an underwriting decision, and enables folks in their local communities to make a pretty nice, recurring revenue stream of selling and Cover products and related products all from a single interface. And so all of this to say, we haven't been stubborn about where the business is coming from. What we've been very stubborn about is the user experience for the customer and the user experience for the agent, both internally and externally, in helping work with that customer. And I think that's the big change that folks are really, really driving into. And you'll see a lot more of that, I think, over the course of the next year or two.
When you look at go-to-market for Cover, how do you think about it? Is it largely focused on onboarding agents, and then they're the ones who expand the the sort of the underwriting side of the business, or is it you trying to build demand, by going B2C, and then the agents are the ones who are essentially servicing the demand that you bring them? Like, in which order does it happen?
Yeah, so we started as a D2C business, and I think we did a good job of configuring a business model that kind of made sense. So we sell within our cover apps our own cover products. We own and operate a national insurance agency. So if cover is not the right fit for you, we have every other insurance company that's non-captive in the United States represented on our platform. We have a variety of other value-added services. We've got a pharmacy program for customers who are underinsured, in a concierge service that makes it dead simple for folks to make claims and message our agents in an easy way. And I think if we were to do it again, we probably would have gone agents first. We did a really, really good job of tying off what it is that our customers want on a consumer and servicing end. But what we're finding now is that independent agents are a massive, massive driver of our growth. Right? We went from basically 0 to 3,000 brick and mortar locations in a year. And we're going to end up at something like 10,000 over the course of the next year, which is not insignificant from a revenue run-up perspective. And I think our experience building software for our end customer and for our internal agents to be able to sell that customer is paying really significant dividends when we're thinking about scaling, to third parties that are selling on our behalf. A lot of the problems that they face are the same problems that our internal agents faced, right? Clunky software, unresponsive software, inaccurate pricing, lack of flexibility when it comes to being able to cross-sell into related products. Through a cover instance for an external agent, within a auto insurance quoting flow, if a customer indicates that they've financed their vehicle, for example, and they sit within a credit score band that, it kind of makes sense for us to help them refi that vehicle. Within that quoting flow, an external agent can arbitrarily help refinance a car in addition to an auto insurance policy. So the way that we're thinking about this is, hey, what does the end customer want? Does the independent agent really have the tools to be able to fulfill that? Are they really revenue maximizing and utility maximizing for their customer? And the short answer of that is there's a lot of work to be done in that regard. It covers, probably amongst the first that's really, really taking a big bite out of that.
What can you share on somebody who's feature shopping versus somebody who has the relationship with the whole brand? Like, how do you think about that?
So the second part to this was it's kind of a virtuous loop, right? Like you build an elegant experience and a sale process to an external agent, and you immediately follow up with utility, right? Like every one of our externally sold policy, those customers receive a text message, the link to a personalized onboarding, on the cover app that gets them access to their insurance cards that they can embed in Apple Wallet, gets them set up with their servicing hotline, gets them set up with the ancillary products that we make available through the app. So I actually think about it as like, hey, these two things can work together very, very neatly. And that's kind of where we see this going, right? Like it's not just tools to sell, it's tools to service, and to leave a very positive reflection, from a tooling and a serving experience for that external agent once they sold the customer as well.
One last question around agents, because I know a similar model in the financial advisor space, and where you have these software technology platforms that independent advisors use to service their clients. And often there's you end up, quote unquote, acquiring the advisors on your platform. Like you actually end up buying out their practice. In the recruitment of the third-party advisors or salespeople or agents, how do you draw them? Like, are they making a purchasing decision about software to improve their practice, or are they essentially joining your business as a contractor and there's some incentive to do that? Like, what's the relationship?
We treat it a lot like B2B sales, right? So we're arriving to an agency with a competitive product, a software experience that is superior to the one that they use today, and it costs them basically nothing to get. It costs them actually nothing to get up and started in selling cover. And so, to that end, we've kind of borrowed from playbooks of folks who have done it before, right? We've got folks on staff that ran the entire external agency marketing practice of publicly traded insurance companies at Cover. So it is, there's a regimented process by which we reach out, we convey the value proposition, which is price competitiveness, revenue expansion, ease of use, and then we ultimately onboard and appoint independent agents. And we've been lucky to have a number of superstars on the team to be able to help us round that out.
That's awesome. Thanks for diving deeper into that. Okay, so one of the things we also wanted to talk about today was some of the work that you're doing under the hood as it relates to the crypto asset class. Can you tell us just generally, what is the intersection that's available for insurance companies and crypto? And then thereafter, we'll hop into what it is that Cover is doing.
Sure. So there have been, a number of initiatives that have been started by consortiums of insurance companies and reinsurers to help primarily reduce expenses. And so we're talking about, immutable ledgers around claims, related reporting. And by and large, I don't know that any of them have had a wide scale adoption or really quick implementation to value kind of cycle. I know that there are still a number of ongoing efforts that are industry wide, but I'm not aware of any that have really made it, for lack of a better term.
I think they made a lot of press releases.
Yeah. There's a lot of. There's always a little bit of that, but that's kind of my viewpoint on where adoption is at. And then within the DeFi realm, you've got folks like Nexus Mutual, Uno, and a handful of others that are taking a diametrically opposite approach, right? Like they're originating the risk with ecosystem partners. The capital that's backing the risks for these smart contract exploits is coming from a community that's particularly interested. I think that's a very noble cause, and they've made quite a bit of progress. But it's tough to say in isolation where it goes. Like if you were to log into Nexus Mutual, you see they have like $500 million in assets sitting around and maybe 14 million in premium that's being generated on top of that. So they've definitely got the capital to be able to do things, and I think they'll have a lot more capital over time. But the cross section of products that are being sold or backed by that pool of capital will expand. And I don't know those guys very well, but I imagine that's kind of part of their roadmap. And all of, again, that business is being originated from other protocols. So now you kind of zoom out and you look at what Cover's doing. Cover acts as an MGA. We do a lot of origination, pricing, underwriting. We take a small portion of the risk that we originate onto our balance sheet. But what we found is that we're getting increasingly comfortable doing so as, our rating methodologies and our underwriting methodologies get more refined. Our economics are much more predictable. And so our general level of comfort in taking on more risk has continued to go up. One of the ways that we can do that without being a pure insurance company as an MGA is to set up a reinsurer. And so we actually have set up a reinsurer on Cayman that allows us to take a meaningful part of the risk that we're originating. We are now, thinking, if you think about, again, what a reinsurer is, it's insurance for insurance. There's really no reason for, which is the Cover reinsurer, to limit itself to just premium that's originated by Cover. Ostensibly, we could work with any insurance company, any MGA, or reinsurer that would, want to offload part of its risk to Re or to a protocol that kind of backs Re. And so what we're evolving to now, and it's a negotiated process, and we're working with regulators to be able to make this happen, is to build the rails that allow crypto asset holders, specifically stablecoin holders, to supply those stablecoins to a protocol that dynamically allocates that capital against a broad cross-section of potential insurance programs. So what we're talking about is a reinsurance entity that could back aviation risk, it could back space risk, it could back nuclear risk, it could back property risk, catastrophic risk. Because of its distributed nature, we're configuring it to look and feel a lot like a decentralized Lloyd's of London, where Lloyd's of London has Lloyd's brokers that originate the risk and bring it to a physical marketplace where you have physical underwriters from a broad variety of different insurance companies, MGAs, that look at, those deals. They quite literally put up their hand and say, I'll take 10% or 20% until a quota is filled out. And the capital itself is being supplied by, something equivalent to names. And so names historically have been high net worth individuals, but more recently, institutional investors that want to deploy capital into an asset class that is entirely uncorrelated from the equity or crypto markets. And so what we're arguing here is that the typical reinsurance treaty, the contract that stipulates, what somebody is paid for originating a type of risk, the types of risk they're allowed to originate, the maximum individual loss, who settles claims, the cadence at which premiums are remitted, it memorializes all those things. And all those things can be encapsulated within a smart contract that also at the same time reserves the capital that's necessary to back those risks. And so we took a lot of inspiration from Lloyd's of London, and I think rightfully so. It's, we're talking about nearly 300 years of evolution to get to a configuration that makes sense, but without significant technology to back some of the processes that they work internally. And so our argument is now you have this global transaction layer for pure risk, backed by crypto asset holders, but decentralized in the sense that you could have underwriters from anywhere on earth, from other insurance companies, reinsurers, MGAs participate within the protocol. You can have reinsurance brokers and insurance companies, MGAs, seed their premium or originate premium and bring it to this protocol, and ostensibly be able to get a better deal because the expenses related with running the protocol are de minimis relative to, some of the frictions that you see with other risk and capital matching mechanisms. And all of that is like living and evolving there in a transparent way. You see what lines of business are performing in what ways. You can see which underwriters are performing particularly well and which should be continued to be supplied with capital, which ones are not, et cetera, et cetera. So that's kind of where we're going. We made a very quick leap from, hey, we've got a reinsurer now, we can arbitrarily take risk, to, hey, let's build the infrastructure that allows for, many parties to help us originate this risk and ultimately underwrite the risk.
That's super interesting and quite a step actually into the space. I think the current state of exposure is just so underdeveloped and then painful for market participants, whether it's, bridges blowing up like the Solana Ethereum wormhole $300 million disaster, or whether it is exploits. And so I think figuring out an industry-wide solution that's able to be integrated and made part of the fabric of DeFi is really key. And I guess one of the questions is, what does early adoption look like? You know what I mean? Like, how do you get started to make it real?
Yeah. So look, I think the distinction here is we're talking about bringing real world risk to a protocol, right? There's already 700 billion in reinsurance dollars that are processed by centralized entities every year. Munich Re, Swiss Re, Lloyd's of London, SCOR. All of these guys are thinking about what happens next with respect to, risk and capital matching mechanism that evolves. So what we're really talking about is something that is like kicking an industry forward, 20, 25 years, right? And it's going to be scary for some people, but it's going to be transformative, for the industry if it actually works. So to answer your question on how it actually works and how it gets started, Cover itself is going to seed something like 50 million of its own premium through the protocol to get started. We recently raised, and we haven't disclosed around, but we have a number of other reinsurers that are participating in fronting carriers that are participating in the round. And we're going to be working with them to bring on a number of programs in addition to Cover to kind of bootstrap the protocol. So, you could ostensibly see hundreds of millions of dollars flowing through Re in short order. That being said, there are still going to be regulatory challenges. There are going to be questions around capital buffer, the amount of leverage that can be taken within a reinsurance treaty, in capital buffer primarily centering around the need for a centralized entity to get a financial rating that gives broader market participants comfort around working with a protocol. And I think that that's a fine and noble direction to head. But to get started, we can get into the many hundreds of millions, if not billions, of premium being processed, through something that's an unrated entity, and focus primarily on short tail business. So if you hark back to earlier in this conversation, things that are a little bit more binary and resolve very, very quickly are at least right now, more appropriate for a protocol setting than something that has exposures out for decades, where capital providers may not necessarily, be interested in locking up capital for that long. So it's a significant BD lift. The rails for distribution exist already, right? So a huge part of the reinsurance market is brokered. A significant part of it still becomes direct, and those are through professionals who are working with companies and insurance companies and MGAs and other reinsurers to absolve themselves of the risk that they don't necessarily want on their balance sheet.
Gotcha. Yeah, thanks for bringing me back. It is a heavy lift, what you're describing, but also, being first is what you get paid for. Yeah.
For sure, right? Like I think we get paid for solving unstructured problems, right? I just happen to be, and the cover happens to be in a unique position where we process a lot of premium. We own a commercial reinsurer. We have the chops and the backing necessary to build a protocol around it. And, if we can do it, and it seems like a somewhat obvious thing to do for us, we're going to go and do it.
For our listeners, if they want to learn more about you or to learn more about Cover, where should they go?
So you can just, on Twitter, it's just at Karn Saroya. That's usually where I'm at. Or, if you want to send me a note, it's karn@cover.com.
Fantastic. Karn, thank you so much for joining us today.
Of course. Really appreciate it.
Hi, everyone. That's it for this week's episode of the FinTech Blueprint. For more technical deep dives into all things fintech and decentralized finance, check out fintechblueprint.com and grab a free subscription to the newsletter. This is Lex, and I'll see you next time.